Hey everyone, I'm back again. As I said, I'll be doing a lot of short videos, and I promise you this one will be short. The last one I tried but I failed and it was 35 minutes. So it sounds like I'm going in the wrong direction. I started with a 21-minute comeback video and then a 35-minute video, and I said in the 21-minute video that I will do 10-minute videos. So I'm going in the wrong direction. I'll try really hard this time to stay within 10-minute bound. So topic for this time is saving versus investing, and I have lots of ideas on this topic, and I encourage you to think about how you perceive these two topics as well, and share your thoughts and comments, and do not forget to subscribe. So without any further ado, I would like to start. So saving versus investing, it's really important to have a particular mindset. When you're approaching your finances. I mean, a lot of people focus on saving, but I personally focus on investing. I don't focus on saving as much. I mean, I save. I think I live within my bounds, but I focus more on investing, and I'll tell you the reason why. Because I think that the investing mindset is more about how to set goals. I mean, not to say that saving is not how to set goals, but with investing, you are setting goals that are much more ambitious, and you're setting goals such that you can achieve some sort of financial freedom. With saving, it's very difficult to achieve financial freedom that you wanna achieve in your life. So I highly recommend approaching, maybe tweaking your philosophy from saving to investing. The difference between saving and investing, the key difference in my head between saving and investing is the risk appetite. I think people who are savers have low risk appetite. People who are investors, not to say that they necessarily have a high risk appetite. Even within investing, you can have a low, medium, and high risk appetite. But generally, investors are long term thinkers, and they're okay with taking short term risk. The approach is more about growing what you got than save what you have. So I think that's kind of the key difference and how to think about it. So just ask yourself this question: are you a saver or an investor? If you are a saver, then think about whether you want to be a saver, you want to continue to be a saver. If you're an investor, then good for you. Go ahead and continue to invest, because that's where the future lies. And the reason, and again, the reason why I keep saying investing is it depends on where you are in your life. If the key resource that all of us have, the only thing that all of us, regardless of who you are, we have is time. And and like it might sound cliche, it might sound cheesy, but time is money. It definitely is. And when I say money, I use it pretty loosely. I don't mean money in in some form or fashion. I don't mean some sort of currency or wealth. And when I say money, I mean something that we all recognize and value, something that we can use to transact with other people, something that we can use to trade, something that we can use to get what we want and give away what we don't want. So that's what money means in this context. So don't blast me with comments about what money means here. I guess you all get the point. So time is kind of the key resource, and being able to utilize time to your advantage is what a good investor does. So kind of clarify the difference between saving and investing, and I'm an investor, so I'm going to talk about investing in this video and future videos. But this is kind of the primer for all you guys who want to subscribe to this channel and talk about investing. In future videos, I'll talk about individual stocks that I'm really interested in, and ETFs and themes, I should say. More than stocks and ETFs, I should say themes. And I want to build like a set, and then go further down to subsets of things that kind of drive that larger set of things that I call a portfolio, and talk about them individually. But from an investing standpoint, I want to talk about what I think as an investor, and what are things that I consider at a very high level. There are two things that I consider at a very high level from an investment standpoint. What is the macroeconomic environment? What that means is how is the world moving? Where is the world moving? What is happening in the world? And when I say that, what is happening in terms of the health of the world? Right now we are going through a pandemic. There's a lockdown. What is happening in terms of the key economies in the world, like the United States, China, India, Russia, Europe? How are these economies doing, and where these economies are headed? And what is driving these economies, understanding the dynamics in the macro environment, and how this macro environment is changing, like understanding banking, understanding business, understanding trade, understanding consumer financing, and understanding consumerism, or consumption, if you will. One of the biggest parts of any economies are humans. Like, humans contribute to the economy, but they also take away from an economy in the sense that we all consume. So understanding what's happening with those key themes is gonna help you guide the investment decision. So understand the macroeconomic environment. The second thing is understand the microeconomic environment, which means what are the microeconomic forces that affect the macroeconomics. So meaning, what is the supply and demand of any particular thing is doing that you want to invest into. So understand the supply and demand equation, understand what affects supply and demand, understand who are the key stakeholders in that supply and demand. So eventually it all boils down to how humans perceive what is limited in supply, and how much do they want it. So that's kind of what's it's boiled down to. So understand that, and if you understand the macroeconomic environment and you understand the microeconomic forces, then you'll be a good investor. The third part that I think is really important is, and maybe I didn't mention the three parts, but the third part is have an independent thought process. So regardless of what you think and how you think about these things, have an independent thought process. Like, gather as much information as you can from people, listen to a lot of people, hear a lot of things, lots of stories, lots of information, consume all that, but then at the end of it, you should have your own independent thought process on how you wanna invest. That's really important. Don't be driven by what people are telling you. Don't just follow a friend who's saying, "Oh, I really believe in this company, or I really believe in this cryptocurrency, or I really believe in this U.S. dollar, or Jap or Chinese yuan, or Japanese yen, or whatever." Don't follow the herd. Don't follow what people are saying. Listen to all of them, gather all that data, and then process it, and then form an independent thought process. It's going to be really important for you, if you are an investor, to have your own thought process, and try to be kind of the opposite of what the herd is thinking. Generally, that's where the value is, when you're opposite of the herd. And this is, like, I guess, out of everything that I've said so far, if there's one takeaway from this video that you can take away, it is to not think like the herd, because herd mentality is bad for investing. Herd mentality is bad for not just for investing, it is also bad for creating value, because generally, by the time everyone has heard, when I say herd, I mean HERD, meaning group, and when I say herd in this context, when everyone's heard about what's happening in the world, that's too late. If your neighbor comes and tells you that this thing is too hot, go and put your money in it, it's probably too late. I mean, it's probably too hot already. It's probably too expensive already. So there's no point, kind of being on the same side of the herd. So have your independent thought process, and the independent thought process is going to drive you to the point where you are understanding and recognizing value that a lot of people are not. And when that is happening, that's when you will create value for yourself. That's when you will kind of create that arbitrage kind of opportunity, where the entire herd, or the entire market, a lot of times, is valuing something pretty low, and then you're valuing something pretty high, and that's where the arbitrage is, and that's where you'll make the value, and you'll keep it for yourself. So this is the only rule to follow. Do not follow the herd. Be opposite of the herd to the extent possible. Have conviction. Well, I guess I'll introduce second rule, which is be patient. If you believe in something, if you understand it, if you've done your research, then stick to it. There's no point, again, if you're wavering, then I guess you should reevaluate, because if you're wavering, then probably that thought process was not very independent. Probably you relied on someone else's thought process and rationale in investing. So don't do that. Go and firm it up, and make up your mind one way or the other. You can play safe. You can play both sides and probably not make as much money. But that's up to you. It depends on what are your goals and how risk averse or risk taking you are. But generally speaking, there are lots of inefficiency in the market. And when I say inefficiency, meaning not everyone perceives the risk the same way. That's what it means. It means that if you perceive something to be valuable, someone else does not perceive it to be valuable and are ready to trade for it. So explore that and kind of exploit that. Have an independent thought process. Understand the risk. Understand what's driving the value. Do not follow the herd. And then I want to, we are almost, we have just gone past 10-minute mark, but finally, have a goal. Nothing can be built. Rome was not built in a day, so you're not gonna, become extremely wealthy in a day. Have a goal, and meet that goal sooner than what you planned for, and then keep iterating on that goal. It's very important, because a lot of people kind of see this big problem, and they they kind of give up because it's too big a problem to solve. What is important is to take the first step. Do as simple as just get out of your bed and start researching. Read one article, read or listen to one person, and then that thing will build onto itself and build a momentum. So building momentum, and this is a separate topic that I'll discuss about philosophy and the power of building momentum, but building momentum is very, very, very important. If you want to do something that is big, if you have big ideas, building momentum is the only way to achieve those ideas. If the problem is tough, you do not approach the problem, or you're not going to solve the problem on the first day itself. You're going to chip at that problem slowly and steadily and make progress. And there will be a tipping point after which that problem will not be as big of a problem. So it's very important to build that momentum. It's very important to take the first step, and build on that. So, and finally, I guess we are a minute and a half ahead. I'm just trying to time myself. I'm not really good at this. I'm still trying, so I apologize for that again. Finally, have some sort of investment thesis. Have themes. Have themes that you believe in, or understand, or have some sort of very unique perspective on, because those are the things that are going to drive value for you. If you know what is unique, if you can identify it, if you can follow it, if you can be patient about it, you will be successful. So with that, this is like kind of a very, a primer video on saving versus investing. And, I just wanted to throw some ideas out there for you to explore. But these are the themes that we'll be discussing over the next few videos as I talk about my own personal style of investing, my own personal take on risk, and my own personal take on where the world is headed and where there are opportunities for all of you to benefit from. So until next time, stay safe.